Hey everyone, ZIM Integrated Shipping stock price has soared ever since I made the buy recommendation a few weeks ago. So in this video, I'm going to highlight why I think it's time to take profits and sell your ZIM Integrated Shipping stock if you bought it when I recommended it a few weeks ago. So let's get a look at the analysis and why I'm recommending it's a good time to take profits.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So here is ZIM Integrated Shipping Services stock price change in the last month, growing from $7.50 per share all the way up to $13.10. That's an accelerated stock price increase for a company that's not really a growth stock, that's not really in a position to experience this kind of stock price gain, save for the very rare circumstance. And let's share what that is. And it's been the attacks in the Red Sea. Those attacks in the Red Sea have created a spike in ocean shipping rates that are spiking in certain lanes in the Red Sea due to higher operating costs for carriers. As of January 3, rates from Asia to Northern Europe rose 151% week over week. Asia to the West Coast grew 63%. And so this volatility, these attacks in the Red Sea are causing these freight rates to spike. And what worries me is that these spikes are temporary, that these spikes are not long lasting reasons why ZIM Integrated Shipping is going to experience higher shipping rates. This would be different if there was a rebalance of consumer spending more towards goods. As you might already know, lately people have been spending more money on services, less money on goods, and that's what's created this decline in freight rates. And that's the reason, that's the longer lasting reason I would prefer for freight rates to rise. And if that was the reason, maybe I wouldn't be recommending this as a time to take profits. Now, here was the video about 3 weeks ago where I said ZIM stock is down 91% in off its high. Is the stock a buy for 2024? And in that video, I suggested that the risk versus reward was in investors' favor, that it was a good risk to take with ZIM stock. The stock was absolutely cheap and you were getting it at a relatively cheap valuation, and I suggested it was a good time to buy it. Well, since then, the stock price is up meaningfully. You've experienced significant gains since I made this recommendation. And so now I'm saying, because of the short-term nature of the reasons why the stock price is up, I think it's a good time to take profits. Also, I made a ZIM stock price prediction for 2024. And in my estimates, I had several estimates. I ran several scenarios where I thought ZIM's valuation could end up here. Estimated stock price $8, $12, $21, or $4 in the 4 different scenarios that I ran. And I came to the conclusion that the stock price could end up 2024 between $10 and $12 per share. And I was saying, hopefully it ends up on the higher end of that range. Well, it's already, the stock price is at $13 per share. So it exceeded even my bull case for 2024 already in just a few weeks. So why not take the gains here? Especially because, again, these are temporary factors. You don't know how long these disruptions will last in the Red Sea. You don't know how long these will impact the company revenue and sales. In fact, when I did this video, when I was looking at the company's revenue estimate for 2024, analysts had estimated that ZIM would deliver 4.89 billion in revenue for 2024, and that has gone up to 5.07 billion. So a roughly 200 million increase in revenue is now expected for ZIM in 2024 from all of these disruptions in the Red Sea, according to Wall Street analysts that follow ZIM stock. So the expectation is not for a huge surge in revenue for ZIM for 2024. Perhaps the analysts are expecting this to be a short-term issue and for freight rates to drop back down as these tensions in the Red Sea ease. Looking at ZIM price to sales ratio. The price to sales ratio measures what you are getting for the price you are paying in terms of sales. So what are you getting for every dollar in sales that you're paying? For example, in this first example, the market capitalization is $1.25 billion and the sales for the previous 12 months were $185 million. That means you're paying a price to sales of 6.76. Similarly, if you look at the expected next year revenue, you would be paying $1.25 billion for $465 million in revenue expected, and that would mean the forward price to sales ratio is 2.69. The factors that influence the price to sales ratio include profitability. Of course, you would be willing to pay a higher price for a company that generates higher profits. That means $100 in sales will turn into $20 in net income for a company that has a 20% net profit margin. That same $100 in sales will only turn into $5 in net income for a company that has a 5% net profit margin. So companies with higher net profit margins tend to sell for higher price to sales ratios, all else being equal. Another thing that influences the price to sales ratio are growth rate expectations. All else being equal, companies that are expected to grow at a faster rate sell for higher price to sales ratios. Similarly, higher total addressable market opportunities tend to result in higher price to sales ratio because investors see this company being able to grow for a longer period of time before hitting the ceiling. And finally, cyclicality. Companies that are more stable and less cyclical tend to sell for a higher price to sales ratio because cyclical companies are seen as being more risky. Companies like McDonald's are seen as being non-cyclical. McDonald's does relatively well whether the economy is booming or whether the economy is in recession. And so investors would be willing to pay higher price to sales ratios for companies that are less cyclical. Investors use the price to sales ratio when a company has negative earnings, unstable earnings that fluctuate between positive and negative, and also the same for cash flow. If a company has negative cash flow or cash flow that's fluctuating from positive to negative, the price to free cash flow and price to earnings ratio are less informative, so analysts use the price to sales ratio. That being said, you can see ZIM's price to sales ratio shooting higher from 0.12 a few weeks ago all the way up now to 0.256. Look at this explosion. ZIM stock is now trading at a price to sales ratio close to the most expensive it's been in the last year. So it's right up here, up in the top part of its range where it has been in the last year. When I recommended the stock, it was closer down here near the lower end of where it has traded for in the last year. So for all of these reasons, I think it would be a prudent decision to take your profits if you had invested in ZIM stock when I recommended it a few weeks ago. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.